Thank you, everyone who's tuning in today, and thank you to our esteemed panelists for joining us. I'm Melissa Koide. I'm the CEO of FinRegLab. We're a DC-based nonprofit research organization evaluating the use of technology and data in the financial system to inform public policy and market practices and ultimately drive financial inclusion. AI and machine learning models have long been used in financial services, but adoption of an interest in these technologies has accelerated, I think we all realize, fueled in part by the recent arrival of generative AI. Neural networks, gradient boosting, and other advanced predictive technologies are considered by many stakeholders to provide meaningful improvements in performance against incumbent models in things like credit, fraud, marketing, and other applications. Generative AI and AI adoption, more generally, have led to both the exploratory use of these large language models, largely in banks' back office operations, exploration around coding improvements, as well as data translation activities. Gen AI and AI adoption has also led to increased attention to financial services policy and regulations regarding model risk management, accuracy, fairness, expectations, and questions around explainability and requirements around explainability. There are also the potential consumer benefits as well as benefits to the financial system. In credit, machine learning's greater predictive power, particularly when paired with more representative data like cash flow data, means the technologies may better risk assess consumers and small businesses who have been historically underserved. More accurate fraud detection could increase the ability of the financial sector to better uncover and understand true fraud risks and decrease the risk of false positives. AI deployment in customer service and in financial information and advice giving has the potential to help consumers access personalized information when they need it and no matter where they're located. At the same time, I think we all realize applications of AI and machine learning in these high-risk, high-reward use cases, credit, fraud, as well as things like marketing, these are high stakes. The very quality that fuels AI and machine learning models' predictive power, the ability to detect more complex data patterns than prior generations of algorithms, can make them more difficult to understand and increases the concerns that they could ultimately exacerbate inequalities, as well as poor performance in changing data conditions. FinRegLab, as I know some of you realize, has been researching machine learning and artificial intelligence in financial services since 2019, focusing largely on machine learning algorithms and data in credit underwriting. We found, with respect to important questions around explainability, some of the techniques can generate reliable explanations of which features were most important for the credit model's predictions. And that was even true for the more complex machine learning algorithms. Yet also very importantly, there was no one-size-fits-all technique or tool for generating reliable explanations. Our results emphasize the importance of human oversight and expertise, both with regard to the models and importantly, the underlying data. We also found machine learning has the potential to improve fairness and inclusion. Machine learning automated approaches produced a range of alternative models with smaller demographic disparities and better predictive performance than traditional fair lending methods. As the adoption of these technologies accelerate, and I do think we all agree there's not the ability to put the genie back in the bottle, even if we wanted to, this is an important moment, and we have the opportunity to rethink and improve upon prior generations of algorithms use in the financial system. The coming years could offer the most fundamental review and reset of banking and financial services in decades. And rigorous research, thoughtful deployment, and proactive industry and policymaker engagement are critical to determining whether and to what extent these new systems are benefiting people along with the financial sector. So today, I am so pleased that we have such senior and esteemed policymakers, regulators who are really at the heart of thinking about how we're going to evolve for the benefits, leveraging the benefits of machine learning and AI, and really make sure that we're mitigating the risks. So please join me in your virtual welcome in welcoming Patrice Ficklin. She is the Fair Lending Director at the CFPB. Grovetta Gardineer, Senior Deputy Comptroller for the Bank Supervision Policy at the Office of the Comptroller of the Currency. David Palmer, Senior Supervisory Financial Analyst at the Federal Reserve Board. And Keith Ernst, Associate Director for Consumer Research and Analytics in the Division of Depositor and Consumer Protection at the FDIC. It really is, now that I can see you, it's such a pleasure to have all of you with us. I want to say a couple of sort of quick top line. We're going to have an opportunity for questions to come in from our audience the last 10 minutes of our session. For those who are going to submit questions, please use the Q&A button, which is at the bottom of the Zoom channel. And given that we have regulators who are participating, I'm going to offer the blanket disclaimer. The views of the panelists expressed here are their own and do not necessarily reflect the views of their colleagues or the agencies that they represent. So thank you all for being with us today. So let's jump in. What's happening? What are you all seeing with respect to AI and machine learning in the financial services sector, the financial system, and what have you been focusing on, frankly, both in the past year, but also, let's say, over the past 5 years? Again, some of this isn't new, some of this is very new. Keith, let me turn it over to you to kick us off.
Yeah, thank you. And thank you, Melissa, to you and your colleagues at FinRegLab for organizing this forum and giving us the chance to engage today on what really is an important topic. So at the FDIC, we think about different aspects of machine learning. On the one hand, as people probably expect, yes, we have a focus on ensuring that models are fair, they're compliant with all legal requirements, and that banks are managing their risks appropriately. But we also have a longstanding focus on economic inclusion, on expanding and supporting consumers' use of products and services from banks and insured institutions generally. Now, ML models have the potential to offer improved efficiency, enhanced performance and cost reduction for financial institutions, as well as benefits to consumers and businesses. The most obvious example is expanded credit access for consumers and small businesses that may not have obtained credit under traditional underwriting approaches. But there are other benefits, such as enhancing an institution's ability to provide products and services with greater customization. These benefits could effectively expand economic inclusion in the banking system if they increase access and improve the experience of customers. So that's of significant interest to us. The extent to which technology can yield these benefits and maintain them over time, I think, remains an ongoing question. The answer to that question may very much depend on whether institutions can use them in a compliant fashion and manage the risk associated with them. So I'm looking forward to the discussion where I think we'll get to explore many aspects of those questions.
Super, thank you. Let's just keep it open for a moment. I think we're all inundated with the potential around generative AI, what's being built into the applications we use, that sort of at large. But let's obviously hone in on what we see happening with respect to opportunities using some of these more complex models in the financial system. Grovetta, would love to hear what you're attuned to. Are there applications here or on the horizon that have your attention for a variety of reasons, from a risk mitigation standpoint to opportunities for the financial system? Would love to hear what you're seeing. And David, please be ready. You're next.
So Melissa, good afternoon. And thanks again for inviting me to participate in, as you said, this very timely discussion. So I will tell you, OCC staff are closely monitoring developments in this space, including gauging the use of generative AI among our banks. LLMs are certainly powerful tools, but the financial industry is still in the early stages of adoption in that. And so for our own internal use, the OCC is in the process of considering what tasks LLMs can be used for without creating undue risk. Now, we do take very seriously any systemic risk to the banking system, including threats to the public's trust in any bank. And we're not currently aware of generative AI leading to those types of risks, but we do believe we have to continue to be vigilant about this, given that potential. Now, as a general proposition, OCC staff is seeing growth in the use of AI and machine learning in various aspects of the financial system, including those areas with a direct impact on consumers. Our OCC supervised banks have used AI and machine learning for a number of years. And again, as a general proposition, we see use cases related to fraud prevention and detection and increasing the effectiveness and reach of marketing. Other uses probably include improving the efficiency and effectiveness of customer service and back office operations, as Keith just said. But less frequent, but still notable use cases include enhanced measuring of credit risk and enhanced stress testing and forecasting. We recognize that vendor models are utilized for a variety of purposes. I think that generally we see that primarily in our community banks. And internally developed AI or machine learning is often used for low to medium risk uses, such as to help identify anomalous, potentially fraudulent credit card transactions. And banks with a smaller inventory of AI or machine learning models may utilize more of those vendor models, while we continue to see most of our larger institutions have more of that capacity and development in-house. So I guess I would sum that up by saying, while we see both potential benefits and potential risks in almost every AI or machine learning use case, two areas that seem to hold the greatest potential for good are new uses of AI to support debiasing of credit decision models, which I know we're going to talk about a little bit later, and an area that's not really the focus of this webinar, which is the application of AI models to help in the detection, prevention, and prosecution of financial crime networks. Yeah. So that's what we've been seeing here at the OCC.
That's really helpful. David, I'd love to hear what you're seeing. And I have one question for all of you, which is your sense of, I will say, we have perceived there's a lot of like trying to test and learn in safe environments, right? Not necessarily directly engage with consumers, and really trying to feel out how these more complex models work, which I think is in many ways encouraging, right? Like test it in safe environments before you would bring it. But so feel free to opine on if you're seeing that as well. But David, what's on your mind? How are you seeing the financial services sector really react to these technologies?
Yeah, so let me echo my thanks for the invitation, and it's great to have be on a panel with such excellent colleagues. And Grovetta just proved my point. She gave an excellent summary of what we're seeing. I think I would have said almost the same thing. I think she maybe said it better than I would have, but good summary of where we're seeing things, some operational efficiencies, some things in, the credit space, sort of traditional AI, which it's kind of funny to even use that term, given that it hasn't been in use in the financial system for that long, and then generative AI. One of the things that I think is really interesting is seeing its use differently in different institutions, and even within the same institution, used to different degrees, depending on where an institution might find benefits. The other thing I want to note is that in some cases, institutions are pairing the use of AI with traditional modeling approaches, sort of to get that benchmarking, understanding that maybe the AI approach has some drawbacks, but it also has some pluses that maybe enhance performance, but it needs some more monitoring, or it's used as a check on a primary model or vice versa. So I think it's not just sort of a horse race between a traditional model and AI, or that there's just one model in use. I'd say particularly for things where it's harder to assess performance, where it's harder to get realized outcomes against which to test. And so you want to try to triangulate around the issue. One of the things we have lots of conversations with our institutions about all the models and tools and processes they use. How they use AI is part of that conversation. We've been having that conversation for several years now, and in most cases in concert with our regulatory colleagues when we're talking to institutions. So it's not a new conversation, but it has been interesting to follow the developments in the technology, obviously. And I know we're going to get a little bit more into generative AI in a second, but I would say, one of the things we're seeing is that most institutions so far are slotting their AI approaches into their existing model risk management frameworks because they have those frameworks at hand. They see some ways that those frameworks can be beneficial in controlling the risks, but want to make it clear that's not sort of any sort of edict from the regulators that all AI should be considered models. We have seen some institutions that have AI controls applied outside their model risk management frameworks, and that can be a way that can work, provided that it's done the right way. And so I'll just sort of close on this point, and if anyone who's heard me speak on this before I apologize for repeating myself, but I really try to focus on the definitions, or maybe not getting caught up in the definitions. That is, one person's AI could be one person's traditional approach. So the label that we apply to something, in my mind, is not really where the action is. It's the underlying details. It's the risks that are presented. And so just because something is called AI doesn't mean it's automatically riskier, doesn't mean it's automatically better. And everything has sort of vulnerabilities and limitations, and knowing those is really important. I'll just close, and I know we'll get to this later, but for me, a lot of the action is really in the data. That's true for traditional models. It's even more the case for AI and generative AI. I'll stop there.
Super helpful. Well, I was about to ask Grovetta about supervised machine learning as opposed to large language models, but I take your point, David. It's in the details. The devil's in the details. I want to turn to the consumer-facing side, Patrice, so I've got you next. But I also just wanted to ask David, Grovetta, even Keith, you all supervise large banks and small banks, and we're going to talk about small banks and the implications of the resources required around this technology. But are you seeing major differences in terms of where the smaller institutions are relative to the larger banks? This is sort of a da-da question, but I'll put it out there. It would be good for the audience to hear you all on it.
Yeah, I'm happy to start quickly. I think we are generally, Grovetta touched on this already, we're seeing is sort of in a relative sense, smaller institutions more likely to avail themselves of vendor or other third-party AI approaches. And in some cases, those are more likely to be sort of turnkey approaches, which can work, and if managed the right way, can help smaller institutions keep up with technological developments. At larger firms, we're seeing more in-house development, but also use of some third-party approaches. And this is a good place for me to remind folks that the 3 banking agencies last year issued guidance on third-party risk management applicable to institutions of all sizes, with principles in that document, in that guidance, of how to help manage third-party risks. And so we hope that people see that those principles also apply in the AI space.
I would add for that the OCC, we're always sensitive to the potential challenges that our smaller institutions face, including with respect to the adoption of new technologies like AI. And as I said earlier, while our largest institutions may be able to internally develop the necessary functions to safely and fairly use AI, smaller institutions may actually need to take a different approach, such as leveraging third parties. But that doesn't need to result in an unlevel playing field. Many of our banks, including our smaller institutions, have successfully used third parties for functions, including model development and risk management. And we're currently aware of some institutions engaging with third parties that provide AI models or fair lending testing for machine learning. So the OCC, I think we continue to be supportive of institutions, including smaller ones, following this path when it's appropriate for a bank's business model and risk tolerance, and when it's done in keeping with appropriate third-party risk management.
right? And I guess I'll hop in as well. And, I think my perspective would be largely consistent with what Grovetta and David have answered. I think what I would add is that, how banks respond to technological opportunities like this is going to vary depending on the level of risk, the complexity, the size of the bank and the nature of the technology or even the relationship they're looking at. But fundamentally, while institutions may have different approaches to managing the risk, they all have to have strategies to accomplish that objective, right? And so how they do it may differ, but the fundamental challenge is there for everyone in this space.
Great. We're going to come back on this topic. It's a really important one. We all realize that. Let's turn to the more consumer facing. Patrice, one, any sort of general observations you're seeing, what's on your mind, near term, long term? And then I know the CFPB has put out it's a report on chatbots, which is clearly a place where more complex models are being deployed. Would love to hear your big scope perspective, but also how you all are thinking about applications like chatbots.
Sure. First, let me just say thank you so much, Melissa and Kelly, Gillis, Kerrigan, and Nikhil, and the entire FinRegLab team for hosting this important conversation. And I know you gave a disclaimer at the beginning, but before I go further, I do want to give the rest of it from our legal division. They'll all be very proud of me to note that my comments do not constitute legal interpretation, guidance, or advice of the Bureau. And again, my opinions and views that I state are my own and may not represent the Bureau's views. Like our fellow regulators, we have been working to meet the present moment and ensure that new technologies meaningfully help consumers in their financial lives, as well as small businesses. We at the Bureau can see the potential ways that AI can be helpful to consumers, perhaps in fraud detection or automated disputes, but we want to be precise in our understanding of the various uses and impacts and cautious about how the technology gets released into the world. David's point about the labels was quite resonant for me in terms of what is AI and digging beneath those labels to really understand what the various uses are and the potential impacts on consumers. We at the CFPB worry that the large-scale technology companies who produce new technologies may be influenced in a bid to reshape the consumer financial marketplace to benefit their growth and their market share instead of benefiting consumers. Now, this may sound to you all as though I'm taking an anti-tech or anti-innovation stance, but I would like to offer some historical context on the Bureau's skepticism and our position here. Innovation is in our statutory DNA. It's in the CFPB statutory DNA. Innovation is expressly mentioned in the Dodd-Frank Act as one of our objectives, but true innovation has to also promote the CFPB statutory purposes of ensuring that all consumers have access to markets for consumer financial products and services, and that those markets are fair, transparent, and competitive. To us, innovation doesn't necessarily mean using all available data and technology. In the truest sense of the word, innovation can have a host of meanings apart from new technology. And so when it comes to machine learning, we have been cautiously watching as the technology has been developing. We must be skeptical of claims that are too good to be true, claims that are not robustly tested, and when we are told that we should trust opaque models that aren't fully understood. I would suggest that we need to remember that such claims were made about other trends that proved to be catastrophic to consumers, and in the case of subprime lending, catastrophic to the economy back in the early aughts. In many cases, firms made claims that these so-called innovative loan products and underwriting methods offered significant benefits to consumers and would expand access to financial products, including for traditionally marginalized groups. Instead, these innovations often caused significant consumer harm to the most marginalized consumers and to markets as a whole. Still, given the scope of our mission at the CFPB and the breadth of our statutory mandate, change is inherently necessary, as achieving success across the consumer financial market as a whole requires regular recalibration, as well as applying new and varied approaches to address the needs of America's consumers. And so we as an institution have to be agile to move quickly to address emerging risks. In that vein, as machine learning has developed, we've taken several steps One has been to increase our technical expertise and our talent in data science and analytics to ensure that we identify fair lending violations at each stage of the credit life cycle, and to hold creditors and service providers accountable for fully complying with fair lending and other federal consumer financial laws, regardless of the technology they choose to use. Some of you may have heard this from us before, but this bears repeating. The bottom line is that all financial services providers are expected to follow the law, no matter the technology being used. If a financial institution cannot use a certain type of technology in a manner that complies with the law, then it should not be used. And I will say that with regard to chatbots, that was actually a powerful place where that message was reiterated, right? Because there in our report, as you mentioned, Melissa, we were asking this question about not only whether you can comply with the law, but also it's important for firms to ask themselves whether the technology even works. Does it do what you want it to do? Our chatbot report addressed a key concern that technology may not be up to the task. The purpose of our report was to explain how chatbot technologies are being used by financial institutions and the associated challenges endured by their customers. And what we found and conveyed in our report is that chatbots regularly get the answer wrong. And when a person's financial well-being is at risk, the consequences of being wrong can be grave. In instances where financial institutions are relying on chatbots to provide people with certain information that is legally required to be accurate, being wrong also may violate those legal obligations. Customers turn to financial institutions for assistance with financial products and services, and they rightfully expect to receive timely, straightforward answers, regardless of the processes or technologies used, which is really the basis of relationship banking. We're seeing that banks are moving from simple rule-based chatbots toward more sophisticated technologies such as LLMs and other technologies that are marketed as artificial intelligence. And while chatbots may be useful for resolving basic inquiries, their effectiveness wanes as problems become more complex. And some people are harmed when the technology goes awry. There are many kinds of negative outcomes for the customer, including wasted time, feeling stuck and frustrated, receiving inaccurate information, and paying more in junk fees. I can't see folks in the audience, but I bet if we were in a room together and I asked for a show of hands for those who've been frustrated in dealing with chatbots, there'd be a significant number of hands raised. Financial institutions risk violating their legal obligations, eroding consumer trust, and causing consumer harm when they deploy chatbot technology. Like the processes that they replace, chatbots must comply with all applicable federal consumer financial laws, and entities may be liable for violating those laws when they fail to do so. And so we suggest that when an institution is considering implementing or expanding new consumer-facing technology, they should ask themselves if they would be comfortable with an employee functioning in the same manner. For example, would you be comfortable giving similar responsibility to an employee who regularly gets it wrong? Thanks, Melissa.
Thank you. Really, lots of really important information. Thank you, Patrice. And thanks for the shout out to the team. I'm struck when you say that. I've been following more complex analytics use in the medical sector, and it is fascinating the difference. There was a recent study looking at AI information advice to doctors to diagnose a variety of children's illnesses. And the AI got it wrong 75% of the time. But in another case that I think most of us are very familiar with, using more complex visualization techniques, AI enabled, in identifying high risks of breast cancer, the AI is like just outstripping what the doctors themselves are able to do. And you think about it and pull back and very simplistically consider it. It's the data, right? And what the models are being trained on, which is a really important piece of understanding how these models work, what information they're being fed on. And your comments really, I think, are a great transition because, yes, we have laws and rules of the road and regulations that, from model risk to explainability to fair lending, which give direction and guidance to industry on how they're deploying these more complex techniques. But it's also raising questions, right? And important areas for, do we have the model, or do we have the laws and the policies and the practices right in light of what the benefits are, but what we absolutely expect around, can you tell somebody why they got the decision they got? So let's pivot. David, I'm going to turn to you to just help us set it up. Can you give us a brief overview of the regulatory guardrails for these different risk areas, model risk, fair lending, explainability? We'll talk about adverse action notice generation, but consumer disclosures. And what are some of the challenges related to adopting those expectations and systems to AI and machine learning, while still wanting to see the benefits that may come from the technology?
Sure, yeah, happy to do that, and eager to hear my colleagues' views as well, of course. So I mentioned the model risk management guidance. That's something in which I've been involved over a dozen years now, and as I said, a lot of our institutions see applicability of the principles in that guidance to their use of AI. And as I said, in most cases, they're classifying AI approaches as models. And they say, well, it's convenient then that they have a framework that they've built up since the agencies issued their model risk management guidance a dozen years ago. And so what we really want to emphasize, though, is, and this is true even before we got to AI, if you asked us about the principles in the model risk management guidance, we said they're principles. They're not rules. They are certainly not requirements. And there should be a lot of flexibility in how those principles are applied to different kinds of models. So we sort of wrote that guidance to apply to kind of the lowest common denominator types of models, with the understanding that what institutions do really should, vary according to the specific circumstances. One thing I'll focus on that's really germane to AI is this concept of conceptual soundness. And that is something that is integral to our model risk management principles. Just having an understanding of how something works even before you assess its performance. Importantly, though, in that guidance, we emphasize this is an important principle, but it was not a principle that we said absolutely has to be sort of met, or there has to be full explainability all the time. We recognize that there could be cases, highly complex model, or say a vendor model, where the bank doesn't have complete information about how something works. So we've said for many years now that a bank can still use models where they don't have full explainability. They may need to do some other things to get comfort around its conceptual soundness, or they may need to apply some compensating controls or limiting factors, so to make up for the fact that they aren't able to understand how it works and therefore arrive at the full conceptual soundness assessment. So that's obviously something that is relevant to AI, this whole explainability question. So I just want to make it clear that, and this where I get again into the definitional issue, it's not just AI where explainability challenges can arise, but it's also not the case that we're saying that all AI has to be completely explainable. Now, importantly, and obviously I'll defer to Patrice and others on this, when we get to the consumer space, there are some very specific requirements about explainability, and so those arise. But coming at it from a safety and soundness perspective, there is some of that gray area. So I think it's helpful to think about that. I mentioned the third-party risk management guidance earlier, the principles in that. We think those have applicability to the use of vendor or other third-party products, but the agencies also have other resources out there, such as the FFIEC IT handbooks, which talk about data governance and other practices. Obviously, the existing consumer laws and regulations apply. And so what we are looking at right now as the agencies is, what maybe additional information might be helpful to provide. And that's a conversation we're engaging in right now. I will note before pausing is we did release, the agencies were involved in language or helped craft language in the recent Financial Stability Oversight Council report, annual report. Was a section on AI in that document where we even get into things such as generative AI. So I refer people to those 3 pages where we try to lay out uses we're seeing, risks, some of the pitfalls, and then how we're seeing institutions try to have the right controls in place.
Yeah, that's a good shout out. I realize the data question is somewhat context, use case specific, but I still have it for you. David, do data sources, data types, alternative data being used, does this make things more complex as you all think about regulating, whichever definition of AI or simple model might be deployed? I think it's relevant in even more simple types of algorithms, but.
Yeah, I would say so. And I mean, starting with sort of the traditional modeling approach as a supervisor, when we were engaging with institutions about their models, that was one of the first places we would look. What are the data supporting the approach? I'd say that's even more the case with AI, in part because in many ways, the data are doing more of the heavy lifting in arriving at a way to determine relationships or make projections or forecast things. The other thing that we've seen is there's often a higher volume, a higher velocity, and a greater variety of data being used with AI. Now, I want to make it clear, you can have all of those things with the traditional approach as well, and therefore you'd still have to have better data governance. But we're often seeing the pairing of larger volumes of data coming in at higher speeds, more alternative, different types of data being employed. And then you may have on top of that explainability challenges. So that can really introduce some risks. And so those are things that really need to be taken into consideration.
I can't help but ask this question. Are we going to need to rethink some of our expectations because of the voluminous data, the complexity of the data, what these more complex models do with the data? In some cases, we don't have, and this is true outside of financial services, but the ability to generate explanations on these more complex models. I'm assuming your answer is we're all like taking it in and learning, and but what would you say to that? And what would anybody else say to that too, on that rather vague but important question?
Yeah. So we are having conversations, among the agencies, obviously with our institutions, with other parties on this topic. We continue to solicit feedback from the industry, from consumers and others about where maybe further clarity might be helpful. So, we're engaging in those conversations. I'm sure Grovetta and others, have some thoughts there as well. But the good thing is the agencies are discussing very closely all these issues. We have regular meetings on these topics. And so, and where we can, we try to provide some clarity, such as in this recent FSOC report.
Grovetta. Yeah.
I'll jump in on that one too, because I think when you talk about the data considerations David brought up and that you're asking about, Melissa, I think really the AI models generally are most effective when they can utilize large data sets. And that, of course, puts a premium on the quality of the data, both that's used to train the AI models and then is used on an ongoing basis. So ensuring the high quality data is always a challenge when working with traditional data sets. And that's only going to be heightened when non-traditional data sets are used in conjunction with an AI model. So with regard to the non-traditional data, we're seeing growth in the use of data not traditionally used in credit decisions, or what I guess we sometimes refer to as alternative data. And the OCC recognizes that the use of alternative data may improve the speed and the accuracy of credit decisions and may help firms evaluate the creditworthiness of consumers who currently may not have credit in the mainstream credit system. So these types of innovations offer the potential to lower the cost of and increase the access to credit. But as with AI, any other novel approaches to offering credit that we're seeing, the use of that alternative data raises questions regarding how to effectively leverage new technological developments in a manner that's safe, sound, and fair, and it's consistent with applicable consumer protection laws. So I think through our bank supervision, the OCC assesses whether lenders appropriately manage credit risk, operational risk, compliance risk, all of that from the use of alternative data. And in particular, our supervision, we really focus on compliance with fair lending laws, prohibitions against unfair, deceptive, or abusive acts or practices, the Fair Credit Reporting Act. So I think it's really important to note that our supervision approach is technology neutral. And so it's really well suited to ensure the safety, soundness, and fairness of our lenders' use of alternative data, is occurring without stifling innovation. Now, I can't not be on this panel without giving a shout out to what I believe is like the best piece of joint guidance that we really never had an opportunity to tout given the pandemic, and that is the joint interagency statement on the use of alternative data in credit underwriting. We issued that on December 3rd of 2019. I think everybody remembers what happened in 2020. So our usual, tour around the country to talk about, what that alternative data could do and the, both the challenges and the opportunities. I think I'd like for people to just go back and take a look at that, because I think it is still incredibly relevant, particularly as we talk about the models that we see today with AI and machine learning.
And if I could, I'll just add one more point that was triggered in my mind by Grovetta's comments. Totally agree with those. I think anybody who's familiar with modeling knows, like, the data sets. You can't just take a data set out of the blue and use it. You've got to sort through it. You've got to curate it. Data sets require care and feeding over time. And so if you have alternative data sets where they don't have as long a histories, they don't have stability or consistency, that's an additional risk that you need to take into consideration. Doesn't mean you can't use them, but it might mean that there's additional work that's needed to make sure they can be used.
Yeah, and maybe I'll jump in just to connect this conversation back to a point Patrice made, which is there's a fundamental question presented in the model risk management guidelines that asks developers to think about fitness for purpose, right? And so Patrice raised the question, is this the right solution for the problem at hand? And part of the consideration there is the data relevant to the institution, right? Institutions need to decide, does this data, will it speak to the experiences I expect to have in the context I operate and in the line of business that I'm working on in terms of this model?
Yeah. Excellent. So let's hone in now, come back around some of the consumer implications and the, frankly, fairness and potential inclusion implications too. The potential, Patrice, of debiasing techniques with machine learning algorithms and other overlay applications, things like adversarial debiasing, searching for fairer models, has highlighted questions. We hear them, advocates have raised them, industry is raising them, about how, when and how lenders should actually search for less discriminatory alternatives as part of their disparate impact compliance program. What are your thoughts about the potential of finding less discriminatory alternative options and, approaching, using machine learning approaches to try to find these LDAs?
Yeah, thanks, Melissa, for the question. Before I dive into that, though, I can't resist an opportunity to also just build on the great comments from Grovetta and from Keith and from David with regard to data. And I loved the shout out that Grovetta gave to the 2019 interagency guidance. That really was a great piece of work. You know, I just think in terms of thinking about data, you know, from our perspective, I think that just building on some of the themes that the three of them mentioned, again, these new technologies could potentially amplify the risk of bias, or we call this really algorithmic bias when we're referring to it inside the Bureau. And this point about data is one that we've been spending a lot of time speaking about and thinking about. And we at the Bureau are focused on the fact that data harvesting on Americans has become voluminous and ubiquitous. And this massive effort at data harvesting is giving firms the ability to know highly detailed information about their potential customers before they ever even interact with them, and perhaps filter offers or perhaps even target not so helpful offers based on those sorts of data. The information gleaned from data analytics has a broad range of uses by financial firms, again, including targeted advertising and credit decision-making. But as my colleagues were pointing out, not all data are created equal, and not all data sources or variables are appropriate for use when it comes to making credit decisions. And so there are a couple of key questions that we at the Bureau would like to see more consideration of. For example, does the data source contain errors, or is it unrepresentative in ways that create fair lending risk or are unfair? Secondly, do the data include prohibited variables or variables that are proxies for a prohibited basis? I cannot count how many times firms have come to make presentations to the Bureau and displayed a PowerPoint deck that includes something about age or criminal history or other variables that are either prohibited or proxies for prohibited basis. It's surprising that they would come to the regulators and tout a new model or a new technique that actually uses prohibited terms, prohibited variables. And finally, another question with regard to data is, does the use of the variables, even if they appear neutral on their face, have a disparate impact on a prohibited basis, such as by reflecting historical discrimination? And then leading to the second part of what I wanted to speak to, which is responding to your question, are there less discriminatory alternative models that would actually meet the same legitimate business need? And so segueing to LDAs or less discriminatory alternatives, fair lending testing is something that's critical for all models. And some folks in the audience may have heard me speak to this previously, making the point that regardless of whether firms use more traditional methods or newer techniques, they're still responsible for robust fair lending testing. So I have a couple of observations I want to share about testing. That robust fair lending testing of models, and this in some ways will have echoes of what David was saying earlier with regard to broader model governance, but robust fair lending testing of models should include regular testing for disparate treatment and disparate impact, including searching for less discriminatory alternative models. Rigorous searches for less discriminatory alternatives are critical, and it's important that firms avoid shortchanging this key component of testing. This testing should be updated regularly as well. But in addition to looking for LDAs or less discriminatory alternatives, they also need to make sure they don't overlook the fact that alternatives testing is not effective in a vacuum. Alternatives testing alone cannot guarantee that a credit decisioning process complies with fair lending laws. Well, the testing may reduce disparate treatment and disparate impact risk in a specific model based on the data that modelers have made available. But again, the institutions need to review the appropriateness of those data that the model is ingesting as an essential step in an effective fair lending testing program. In addition to that, effective fair lending testing doesn't just apply to model output and identifying LDAs and the data, but other steps in the decision-making process must be evaluated because they can inject disparate treatment or disparate impact into credit decisions. These include cutoffs, overlays, and thresholds that are applied to a model's output. So really the bottom line is that even when a financial institution begins to use machine learning models, nothing changes when it comes to their obligations, the financial institution's obligations to consumer fairness. The law is technology neutral, as you heard earlier, one of my colleagues. In fact, we talk about the fact that there's no technological exceptionalism, right? That gives, bright, shiny, new, innovative techniques or methods an exception from the consumer protection laws. The CFPB still expects financial institutions to comply with all of the statutes under our jurisdiction, whether they're using machine learning or not.
Really helpful. Others, any thoughts or additions to Patrice's comments?
I'll just add what we really try to do within our own agency and across agencies is underscore that the things we have to say regarding safe and sound operation of these AI approaches and the things we have to say regarding consumer protection really have a lot of synergies and can really build on one another. So they're not siloed. And so good data governance from a safety and soundness perspective can help a lot with good data governance for consumer protection. Might not get you all the way there. There might be obviously be some extra things you need to do, but it could maybe identify some of those really low-hanging fruit problems. Same thing for when you're just putting together your model and identifying variables that you want to include, having that conversation. And we're seeing a little bit more of that with some of our institutions where they are bringing their consumer experts in on the front end to sort of prevent the problem before it starts rather than identifying it ex post.
Yeah, I'll jump in just to underscore that point. I think one of the things this conversation is, helpfully underscoring is how consequential each choice is in the process. So we're talking about data selection of methods. We're talking about testing for alternatives, monitoring and practice. And at all of these steps, institutions are at crossroads. They're making choices. And so having people with expertise, particularly expertise in consumer protection requirements, involved through those stages and not just at the end to ascertain whether the technology should be considered compliant, I think is really helpful for institutions and something that should be taken to heart.
Keith, I'm going to keep you going, and we're going to pivot back to implications of these sort of advanced technologies, the computational power required, obviously the need for access to data to leverage these systems. And, one application that is core, whether you're big or small, is mitigating fraud risks. And we know fraud has been just detrimental to so many institutions over the past few years. Nobody expects it to get smaller, given everything that is so driven by online. What concerns, though, to hear from all of you, and start with you, Keith, Grovetta, all of you, what concerns are you hearing from smaller institutions, community banks, with regard to advances in AI and even supervised machine learning? I'll just let you take it from there.
We certainly have heard from bank representatives that evaluating and overseeing particularly third-party providers of advanced technologies can be challenging, especially for community banks. They report that third parties may be reluctant to reveal, let's say, the secret sauce, if you will, of their algorithms. But I think, David touched on this before. Their banks of all sizes still have the obligation to oversee and control the risk of any activity, no matter the source. And I think there are different choices they can make. And so the third-party risk management guidance, for example, explicitly recognizes that banking organizations can use services of industry utilities, consortiums, can consult with other organizations, or even engage in joint efforts to supplement their own due diligence. And in fact, the principles themselves can be applied to third parties that provide and implement and assist in assessing these solutions, right? So there are a variety of sources that institutions can turn to find their way through the technology. what's important is that they make the choices that are tailored to their risks in their context. And so we certainly do hear concerns, including from smaller institutions. And I think I would, be, mistaken not to at least mention for banks that are grappling with these questions, and they can really be well served to reach out to their examiners to discuss how they're thinking about it and to give themselves the opportunity to have that conversation in a timely way.
Yeah, and I'll just add briefly, agree with those points. And we recognize that in some cases, the reason an institution, particularly a smaller institution, might be going with a vendor is they don't have the in-house expertise, right? They're contracting out for that. And that's been something that institutions have done for decades. And we, as the agencies, recognize that there can be a lot of benefits by going with a vendor or other third party. But as was said, there's still some risk management responsibility. I would just highlight that in some cases, even just the kind of first order questions to a vendor or other third party can be really helpful and can help suss out whether that vendor sort of knows what they're talking about, whether they're on top of sort of the particular topic area, and also whether they have a sensitivity to their clients' needs. And I'll just share one case. There was an institution with which we were having a conversation, and they said, well, we had an engagement with the vendor, and then the vendor suddenly decided to provide us with less information about the product's performance. And in my mind, that's maybe a red flag, or at least is worthy of some additional conversations of like, why are you suddenly giving us less information? So there can be some of those kind of first order red flags that can, I'm not saying they'll get you all the way there, and I'm not saying they're a replacement for technical expertise, but they can maybe help avoid some of the bigger issues or help identify things earlier rather than later.
And in fact, Grovetta called to mind the alternative data guidance. I might call to mind the guidance on conducting due diligence for financial technology companies, really aimed at community banks. Is a nice resource for people to look at who are thinking about some of those questions that David is raising. And that was issued on an interagency basis as well.
I'm just going to jump in real quick and add one final thought on that. I won't say final because my colleagues probably have more. But I think in terms of third-party risk management for the smaller institutions and community banks, the guidance that we put out on third-party risk management actually states in the preamble that not all third-party relationships present the same level or type of risk. And therefore, not all relationships require the same extent of oversight or risk management. It is going to be tailored according to the model that is being provided by the vendor. But the responsibility, I just have to state this, the responsibility for sound risk management is that of each banking organization. They have to analyze those risks associated with third-party relationships. They have to calibrate that risk management process. They really need to understand, based on their size, complexity, and risk profile, with the nature of that third party in mind. So while we see and certainly understand and appreciate all of the questions that come in from our community banks and want them to, I would say feel free to utilize that vendor relationship and that third party risk management relationship, they do have to understand and appreciate, going back to something Patrice said, is it working the way that you expect it to? You may not understand that secret sauce of that black box of how it was actually made, but you should know what you purchased it for and what you expect that to do, not only for your marketing, for your effectiveness, for your operational efficiency, and for your consumer. It's incredibly important that be a recognition that the smaller community banks, just understand it's their responsibility. And the key point, I do think that the vendor policy statement that we put out is a good guide in that regard. So that'd be good.
Yeah, I'm going to say this and then I'm going to pivot us, and you all aren't going to be happy with me on this, but I do wonder the extent to which, and Keith, I hear you, some small institutions just may not be naturally in the high-tech digital world, right? They are very local. On the other hand, the ability, and we're learning this even through some work that we're doing around small institutions, MDIs, CDFIs, their ability to negotiate with these third parties and get what they want, and I know you all have heard this, has been challenging. And now we're talking about sort of the potential movement and the risk of the smaller institutions not able to keep up with the advances of what may be offered. Fraud mitigation, for instance, is a big area. Might we at some point need to think about how expectations are set on those vendors? Because, through the small institution who may not have the power to really, hey, we agreed you were going to give me this much data and help me understand the models with this level of specificity, and now you're changing the game, and holy cow, I'm in market, trying to serve customers. I guess I'm just making a point. I'm not even going to let you all respond, so don't shoot me on that. But it does feel like we're going to have to keep paying attention to this topic. Things are getting much more complex and challenging. All right, thank you for indulging me on that. You know what? We'll cover that in our next webinar. We need to make up time though, and so let's shift to explainability. Transparency is the term that many like to use, but do AI machine learning models need to be explainable? Does the importance of explainability really depend on the use case? And David, you kicked us off well by talking about this early on in terms of the model risk management expectations. But is there any more that you want to elaborate on with respect to explainability, both on sort of model risk, obviously the ability to interrogate for fair lending, you need to understand those models, you need to understand your data, other things that you all would want to elaborate on before we talk about the really hot topic of adverse action notice generation?
So I'm happy to kick this off quickly because I think David did set us up for this one really, really well. I say yes, in general, models need to be explainable, and explainability, I think, is multifaceted. So a model needs to be explainable, let's say, within a bank. And then from a bank regulatory perspective, it needs to be explainable to examiners. But then, for instance, explainability is necessary to evaluate, I think, David, you talked about the conceptual soundness of a model and understanding its limitations, which are essential elements of model risk management theory. So explainability is relevant to managing fair lending risk, in particular when a model leads to a disparate outcome. And appropriate model risk management should include a robust search for, as Patrice said, less discriminatory alternatives, which can then be facilitated by explainability. So while explainability is a part of model risk management, is consistently important, the more complex a model, I think the greater the challenge is in explaining what that model is. So if there's a use of machine learning models and it elevates the importance of considering explainability and ensuring adequate tools are available and used to understand how that model is operating. So the aspects of a model that need to be explained, I think, will depend on the risks that are being managed. So if you are, for example, evaluating conceptual soundness, that may require understanding how the model accomplishes the business objective. But then while you're considering less discriminatory alternatives, it may benefit from understanding why the model actually leads to those disparities. I think really when you think about it, it is two halves, three halves, three-thirds of the same whole. Because it is a continuous aspect, I think, the explainability when they're looking at the models.
Yeah, I agree with that. And I mean, I like to say that explainability is really a means, not an end. So it's a mean to, in my view, getting the ability to assess conceptual soundness, or an ability to explain to consumers, why a decision was made, or to demonstrate that an institution is not violating consumer laws or regulations. The other thing is, for me, explainability is not binary. It's not something is explainable or it isn't. I think there are degrees of explainability. And also, it's sort of explainable to whom? Are you, exactly as Patrice was saying, is it explainable to an institution's or bank's own model risk management group versus to a consumer, to someone else? And so we think it's helpful to think about what are the explainability needs, and then how can an institution meet those needs? As I mentioned earlier, there may be cases where, and again, we had this even before we had AI, right? We were just talking about black boxes and vendor models and secret sauce that is not revealed, right? There are cases where banks do not have full information about how a vendor product, traditional vendor model works, but they're still able to get what they need, either to assess conceptual soundness or to meet the consumer requirements. And so it's a, as Patrice said, it's a multidimensional question, and it's not just one or the other, in my view.
And I guess, it also goes beyond sort of conceptual soundness to just being able to manage and use the models in practice, right? Models that are harder to understand are likely harder to manage. And so, for example, one technique that institutions use, particularly when dealing with more opaque machine learning models, is to monitor the extent to which the data they are using today corresponds with the data that was used during the development process. But it can be difficult as you sort of approach the edges of that space to predict and understand how the model is likely to perform, right? And so that sort of operational risk, I think, is just sort of, a nice example of how explainability and lack of transparency can make things more challenging.
Yeah, I agree with that point. And I'll just add, you even add in a different wrinkle, or an additional wrinkle, if you have machine learning models that dynamically update. And so you are sort of trying to chase down, let's say you maybe have a decent handle on some of the explainability and you get comfortable, but if these approaches dynamically update, then you got to go reset and learn anew how it's functioning. And then we've already talked about how data sets can evolve, and confirming that your data are appropriate. So there are a lot of questions.
And conditions change, to put words in your mouth, David, like, pre-pandemic versus during pandemic.
That's right.
Huge questions around stability and robustness of those models. So Patrice, I know the CFPB has obligation, responsibility, and motivation to really think hard about giving guidance and direction around expectations for creating explanations, so the consumers understand credit decisions that are reached. And you all have issued a couple of circulars on this topic. For our audience who may not be familiar with them, the most recent one, issued last fall, emphasized being clear about the use of data types that consumers may not be aware of being considered, and you talked about that, which, David and others have noted can happen with traditional models as well as more complex models. But just to jump in on this, and let me actually set one more table setting point that anybody could respond to, but it's something that we have spent a lot of time thinking about and engaging with others. It's what are those expectations with those explanations, right? Even under adverse action notice generation and telling consumers why they get the credit decision, its accuracy is a huge one. Its ability for really interrogating for unfairness risks. But we also have aspirations that the consumers are going to take that information and potentially do something with it. And so, David, I liked your point, like, what's the purpose? Patrice, it would be great to hear, that's wide open for you to go where you like, around your all's expectations around explainability. There's a lot in this to unpack.
Yeah, absolutely. Absolutely. And, we turn back to the law, right? And so there are at least two major legal obligations that involve adverse action notices under the Fair Credit Reporting Act and the Equal Credit Opportunity Act. The circulars that you mentioned focus on ECOA, the Equal Credit Opportunity Act. And there, when we look, what we see is a requirement for specificity and accuracy, right? And so that's already in the existing law. And that's one of the reasons why the Bureau has emphasized the importance of compliance with existing laws and this notion of there not being technological exceptionalism, because we know that AI, technology dubbed AI, has the potential to create decision-making tools that might be both uninterpretable and unexplainable for both consumers as well as the financial institutions that use them. And, we've said in several places, including these circulars, that if these types of models do not allow you to produce adverse action notices that are specific and accurate, then you really shouldn't be using those models, right? And so, as you mentioned, we issued a circular in May of 2022, and there we emphasize the accuracy and specificity requirements under the Equal Credit Opportunity Act, or ECOA, and Regulation B, and noting that, again, companies are not absolved of their legal responsibilities simply by using black box models. Director Chopra said, in conjunction with the release of that circular, that the law gives every applicant the right to a specific explanation, and that right's not diminished simply because a company uses a complex algorithm that it doesn't fully understand. And then the most recent circular last September of 2023, as you mentioned, we talked a little further about the appropriate or potentially inappropriate uses of the checklist of reasons, the sample forms that are contained in Appendix C to Regulation B that many lenders rely on when they issue both ECOA and Fair Credit Reporting Act, or FCRA, adverse action notices. And there we cautioned that creditors cannot rely on overly broad or vague reasons for an adverse action, for example, a denial of credit, if doing so would obscure the specific and accurate reasons that were relied upon. And so really just underscoring a point that applies not only to these complex models that may be uninterpretable or unexplainable, but also the non-traditional data, as I mentioned earlier, particularly behavioral data and other types of data that don't have an intuitive connection to creditworthiness that consumers might not expect a company to be relying upon. Those companies need to be disclosing that it is those types of data that they're using to render credit decisions in the instances where that decision is in fact an adverse action. So thanks for the question, Melissa. It's a great one, and one that we've been keenly focused on.
Yeah, and I definitely read that circular, the latter one, as quite focused on the fact that you have an obligation to explain why the credit decision happened. You can't hide things within the adverse action notice code. You really do need to probe and make sure that you're being transparent about what ultimately the variables were that were driving the outcomes.
That's exactly right. And we certainly did not want anyone to misperceive those sample forms as some sort of a safe harbor.
Yeah.
And that was part of the motivation in issuing that circular, is to remind folks that those sample forms are not a safe harbor. There is a freestanding independent legal obligation for specificity and accuracy, and you cannot shield yourself by simply relying on the checklist on those sample forms.
Yeah, absolutely. Do other people want to chime in on this one in particular? I mean, we did spend a fair bit of time in our working group process around the reality of the complexity of trying to ultimately define, especially with four variables, what drove the outcome, right? Understanding the correlations in the data, how you then sort of understand them when you're thinking about sort of model reason codes. And then, of course, what are you communicating to the consumer that is accessible and understandable from them? And some of the questions that we know show up among advocates in industry is, well, gosh, and the models are getting more complex, and, maybe sort of looking at the data and creating derivatives from different variables. So how do you put that together and make sure that you're doing it accurately, make sure you're doing it in a way that is, interpretable for the consumer as well as accurate. And then there are definitely market stakeholders who see the need to communicate as a way to be doing something valuable ultimately for the consumer, for how they may sort of embark and achieve credit access the next time around. So there's enormous complexity in all this, and it's hard not to think that, it was already sort of an area for probing. I think when we were just talking about regression models, machine learning obviously makes this somewhat more complex. I don't know if anybody has any additions they want to offer on that, but it's something that feels unsettled for sure, I think, among stakeholders.
Yeah, I'm not sure this is exactly to your question, Melissa, but two other things that have come to mind briefly, and I'll be quick because I know we want to get to questions from the audience. The first is, at most of our institutions, I think rightly, they are identifying the cases where their models involve consumers or touch the consumer in some way as ones of higher materiality, and ones where they need to up their game, specifically in the ways of all the things that Patrice and others have outlined. The flip side of that, though, is for some other areas where these approaches are not as material, there may be an opportunity to dial back the sort of need for explainability. It's very case specific. It's not a blanket statement that I'm making, but it gets back to the specifics of everything, explainable to whom, to what. If it's being used as a bit player in an overall larger decision in the organization, and it's one of 10 factors being considered, then maybe the explainability needs aren't as high. The other thing I want to say is something that Keith reminded me of in his remarks. And as you highlighted, Melissa, this question of robustness, or how well these approaches generalize or continue to be accurate and relevant, because some of the relationships that these more complex models might identify can be fleeting and may not apply later on. And so just being mindful of sort of an explanation one day may not actually work, in a year's time.
I think perhaps the one thing I would add in agreement to everything that's been said, as I mentioned before, I think when the models are more complex, clearly the explainability becomes more complex as well, and more challenging. But you also have to think about how some of our institutions have used, let's say, machine learning for years now. It has been utilized in financial institutions to understand behaviors of credit card holders. It has been used for years in order to advance and help inform their marketing aspect. So I would go back to what Patrice was saying about the importance of accuracy if you're doing these adverse action notices, and what opportunities there can be when you have these more complex models. I think that, while certainly not settled, is it beyond the realm that while you're looking at those characteristics of the credit card holder, that when you give that adverse action notice, you're not only noting why that credit was denied, but I think you mentioned, what is it that you can do in order to address those deficiencies that led to a denial, to help you overcome that and be in a better position to be accepted for that credit. There are a number of things that can go beyond those regression models that you mentioned earlier, Melissa, that I think really offer the real opportunities for these types of models to enhance and bring more people into the financial space, where we all know it could be more safe, more sound, and more fair for them. So I think that aspect of looking at the explainability is something that we should all really focus on and see if we can hone that aspect and see if those models can get to that type of outcome as well.
And I'll be very quick, but Melissa, part of the way I heard your question is we have these complicated models. What should be our expectations for how we get to adverse action codes that meet the legal requirements? And I think the reality is for developers who are thinking this through from the beginning, they are making choices along the way. They are constraining sort of the methods they use because they have, as part of their objective, they know at the end of the day, the model has to produce reason codes that are going to meet these legal requirements. So it's not really a case of, can we develop this complicated model and then figure out how to comply? It's how do we develop a model that conceptualizes compliance as part of the requirements for what has to be delivered.
I really like that, Keith. That's good. And you also did a much better job of summarizing my question than I did. We are running out of time, but we are getting good questions in from the audience. And I wanted them tease up the last area I wanted to cover with you all. But before we turn to that, question in combined fairness question. What types of models should be covered by fairness testing? All models that impact consumers, marketing and credit underwriting. Does fairness require a certain level of explainability? Patrice. What types of models should be covered by fairness testing? All models that impact consumers. Come back to the law, right?
Yeah, come back to the law. And, if I had to choose, I certainly would say all models. There was more to the question than that, but I don't recall the rest of the question. Apologies.
Yeah. No, that's okay. I think, asking, are marketing models covered or credit underwriting models covered? Which types of applications by which models are used are covered by fairness testing is what.
Yes, and yes.
Yeah. I do feel like maybe we should amass the tutorials that all of you put together for people, especially in the lending area. So the one area that has also come through in the questions, how are you all managing keeping up with developments in AI and understanding it? And a couple of you alluded to building teams and staff, but let me give the audience member their due. What are regulators doing to make sure they have examination staff that can fully manage oversight of AI systems across multiple use cases? And then specifically, are they able to build challenger models, produce less discriminatory alternative models? And I'm going to put this in our chat so you all can see it. But I think it's a good one, which captures what we wanted to cover, which is what are you all doing to really get your arms around trends in machine learning and AI?
Yeah, and I can jump in on that one. We have certainly taken a number of steps. One of the most important one is staffing up our technical expertise and our talent in these areas, and particularly with regard to data science and analytics. And in addition to that, at the CFPB, we are working to ensure that we can identify consumer protection violations, including fair lending violations, involving these complex models at each stage of the credit life cycle, and hold creditors as well as their service providers accountable for fully complying with the federal consumer financial laws that are under our jurisdiction. I will say that in addition to that, we are keenly interested in hearing from stakeholders to add depth and nuance to our understanding of the potential risks, which are quite dynamic and evolving even as we speak, that are created by these complex computational methods that are marketed as artificial intelligence and machine learning. And I do want to give a shout out to FinRegLab for doing some excellent research and amplifying voices and perspectives we need to hear from. We at the CFPB would love to hear more and learn more on these issues from people with independent perspectives, from industry whistleblowers to academics to consumer advocates, because that information from third-party stakeholders is quite important as well to our effectiveness as a financial services regulator.
I'll just chime in. We have staffed up, either bringing in people with those skills or existing people learning more about these technologies and how they're applied. The other thing, though, that we're trying to do and I've been involved in various aspects of this in our own organization, is we're not expecting everybody to become an AI expert. But what we do try to do is equip everybody with a set of reasonable questions to ask if they bump up against these technologies. And maybe these are just the first and second order questions, not getting into technical details. But as I alluded to earlier, sometimes, just you can learn a lot from answers to those types of questions. You can get a sense of whether somebody who's using one of these approaches has thought about some of these key issues. So that's another way that we're trying to at least equip our examiners to be good consumers of information they get about AI, whether it's from our banks or whether it's from a vendor or whether it's from somewhere else.
And then the other thing that's certainly true at the FDIC, and I imagine at all the regulatory agencies here, we're doing the strategic hiring, workforce planning, we're supporting examiners, but we're also figuring out how to effectively connect people with the sort of more advanced expertise with the examiners who are out in the field, sort of engaging with institutions directly, so that all of those pieces can work together to support our supervisory mission.
So at the OCC, our staff has been studying these types of technologies for a number of years to understand the potential benefits they offer and the risks that they could pose within the financial sector. We do have a dedicated Office of Financial Technology, and that office serves as a hub for developing our expertise and ensuring that OCC staff throughout the agency can have the information they need to support our work in all these areas. So our Office of Financial Technology also helps coordinate the gathering and documentation of information on AI and machine learning use among institutions we regulate, and the AI and ML solutions offered by third-party vendors, as I mentioned before. So in addition, our examination, policy, technical, and economic experts regularly share observations related to AI and ML use made in the course of supervision of our banks. Now, in terms of the OCC's own use of AI, to date, our use has involved, for example, replicating how a lender may use AI and ML in credit decisions.
Great.
And our researchers have also used some of these tools for certain predictive analyses and to analyze large quantities of textual data. In terms of leveraging these tools for our supervision work, we're still in the process of exploring those technologies to understand how we can use them effectively and safely to ensure fair treatment of consumers.
Really fantastic. Thank you all. Such important conversations. This isn't new, but it is new, and you all are thinking hard about, how to understand it as regulators. Really appreciate your time. I think we did get some questions about future research FinRegLab is doing. Please do follow us vis-a-vis our newsletter. We actually do have some really important work, not announced yet, but in motion around these topics around inclusion and machine learning and representative data. So more to come. Again, thank you to these esteemed group of experts. Really appreciate your time. Thank you.
Thank you so much.